We've talked about signs of optimism, but these are still some tough times out there for investors. And so the topic of this fireside with my friend Jenaro, Cardona-Fox, is bear market investing. Jenaro, why don't you introduce yourself really quickly, and then we'll jump into it.
Sure. Hey everyone, I'm Jenaro Cardona-Fox. I'm the founder and CIO of Northground Capital, which is a Boston-based investment manager focused on closed-end fund arbitrage.
So, Jenaro, I think for a lot of investors, the obvious safe haven is cash, right? So, and I've seen this with particularly, say, a retiree like my mother. She sees the market falling and she said, well, it's going to go to zero. I got to get out, right? So this is, I think that's a knee-jerk reaction that a lot of folks have because they want, they see things going the wrong way and they get scared. So what do you think of cash as a strategy?
Yeah, no, I mean, as someone who's invested in these markets for 15 years, I can totally sympathize to the desire and the draw of cash as an alternative. Where I take issue with cash is when context is ignored. And today we're in an environment where you can now earn 4%-ish on short-term treasuries. 8% tax-effective yield on some munis, particularly if you're willing to buy them with a closed-end fund wrapper. And so, once a decision is made to find an alternative to cash, then the question becomes, do I go and take a directional approach, or do I take more of a hedged approach? And in an environment where you can take a hedged approach and limit the downside risk while also capturing, some real yield, it seems like there's some really attractive opportunities as a cash alternative.
All right. Okay. Now for the fun part. So, Jenaro, tell us about your strategy. It's not cash. Are you long the market? What's your approach here?
Yeah. So, we're long alpha and we're short beta. And so, what I mean by that is we're long idiosyncratic and discounted portions of the market, and we're short the broader fixed income and equity market. The strategy that we utilize looks at the U.S. closed-end fund universe. And so for those that aren't familiar with closed-end funds, they're essentially open-end funds that issue a finite number of shares, and as a result, can trade at premiums or discounts of their underlying net asset value.
Now, Jenaro, can you tell us how well, I don't know how much detail you can give here, but as much as you can. Tell us how you did last year. I'm not sure how much the S&P was down, these statistics off the top of your head, and how did you do?
Yeah, I mean, the S&P was off, call it 18%, and we were able to hold our head above water and generate good returns. And I think part of that is the fact that, one of the dynamics that's taking place in the market is that, as volatility has increased and we've hit air pockets, market participants beyond the Fed have withdrawn liquidity. And so, that's really exacerbating some of these flows and moves that we're seeing. And strategies that are able to, find opportunities in illiquid markets that are only becoming less liquid, and hedge with, broad market ETFs, for example, are really able to capture alpha and earn their fees.
If we can make this a little bit more concrete, can you give us an example of when this opportunity was, that looked especially good? So during the end of the year when there was tax selling and that sort of thing, was your strategy, more effective at that time?
Yeah. So I mean, historically, the strategy has performed quite well in January and February because of the tax sell-off that takes place at the end of the year. That was only combined, and enhanced this year with the broad sell-off in December. And as a result, January has proved to be an attractive month, a good month. So
now, in January was a good month, but maybe not quite as good as the broader market. And that's something that I think people should understand about your strategy is that, if the market really rips, you're going to be up, but not quite up as much, right?
That's right. I mean, it doesn't have it's a capital preservation strategy. And so, our first objective is to preserve our investors' capital. But ultimately, we're also looking to generate a consistent rate of return. And one of the ways that that can be done is by consistently looking at this, relatively small niche investment universe, which consistently presents opportunities, in part because it is such a broad investable universe. So just to give a bit of background, closed-end funds span equity, fixed income, both investment grade, high yield, loans, and municipal debt. And so at any given time in the market, it presents opportunities when a particular market sells off. There's very little coverage in the space. And so for dedicated investors who are willing to spend their day and night looking at this universe, there's really a coverage gap which allows for outperformance during markets where it seems like everything is correlated.
This reminds me of something that our friend Charles, who spoke at great length earlier, said last year, I think, which is that he thinks, hedge funds oftentimes get too big. What's your view on that, Jenaro? Would you agree that, you don't want to be a $10 billion fund? Is that right?
That's right. Our objective is to stay relatively nimble, to be able to, focus on really on the incentive part of the return and not on the management fee part. Right. And, I think the fact that we're willing to stay of a relative size in a scale constraint universe allows us to not compromise our returns.
I mean, also, I was going to ask you, Jenaro, over time, as arbitrage shouldn't exist, right? So over time, are other people going to catch on to this, and will this opportunity disappear, or is part of the story that you're not doing it on a big enough scale? It's only going to work, with a certain, below a certain number.
Yeah, I mean, closed-end fund investing is no secret. I'm not telling you anything that's not really readily available. I think the trick here is really the consistency and the expertise. The reality is that though markets will continue to fluctuate, new players will enter and exit, the key infrastructure that makes, I think, this market inefficient, I don't really foresee changing.
I think you talked about it a bit, but can you explain just a little more detail about how you hedge? So effectively, you'll buy one of these that you believe is trading, it's mispriced, and then are you able to short the underlying components of whatever it is?
That's right. So the bulk, the strategy is run with a net exposure of, call it, between 10 and 40%, and the majority of the hedging is done via liquid ETFs. And one of the great, developments has been the continuation of the development of the ETF market and the fact of their size and of their bespokeness. And so, though some liquidity was lost over the last few years with the Volcker rule and proprietary desks leaving the space, that liquidity in some ways has been replaced by the increase in ETFs. And so the hedging is facilitated, which only helps to isolate the alpha opportunity.
All right, now since this is a corporate governance event, can you just share any thoughts you have on governance, with the group here?
Yeah, absolutely. So, the way that I think of governance as it applies to our investable universe is that funds that are mismanaged, that mistreat their investors, overcharge, carry too heavy of expense ratios, are most likely to underperform. And so it's always been something that I've kept in mind and that I've been trained to model and factor in well beyond, before kind of ESG became such an important part of investing. As far as campaigns and which is obviously quite topical to this group, one can choose to be an activist and one can choose to partake in activism on a passive basis. And my approach has been more, and our thought is more to partake on a passive basis, mostly to avoid the cost and the time, but also be able to generate some of the alpha on those as campaigns progress and materialize, assuming that the campaign makes sense. Not all campaigns, as you all well know, are created equal.
All right. Well, I've got a couple last questions for Jenaro, but I just want to give the group a chance here. Any questions? Where's Jarrett? We got to pass this guy a microphone. Hold on. We'll get you next. Hold on. Can I run this over? Thank you. Can I restart, Jeff? I think so, Jeff.
Hi, Jenaro. First, I think you're doing God's work. Your strategy is great, makes tons of sense. The closed-end mutual fund universe in total, it's, you said it's kind of a niche market, but it must be trillions, right? I don't know the exact size, but
the closed-end fund space itself is definitely not trillions.
It's not hundreds of billions, or?
Yeah, I would think of it as like in the 350 billion mark. 350 billion,
okay.
And then if you include the UK and the investment trust, that would add another 350, 400.
Got it, okay. So, when a closed-end fund trades at a discount, I mean, that's really, like you said, it's a statement about the manager. right? So, a fund shouldn't trade at 10% below its NAV. And so, I guess the question is, what's the right way? If you're not going to pound the table and, be the activist and, other folks are, what do you think the right way is to get management to take responsibility? To say, look, we're not doing the right thing. We're not serving the public. We're not doing the right thing for investors. And how do you think that should be communicated to the constituents?
Yeah, thanks, Jeff. A couple of thoughts. So our role, first and foremost, is to preserve capital, and second, to generate returns. If a discount is not going to go away because of management or because of the asset class or because of the weather, and it becomes more of an academic exercise, then it'll be an opportunity that I'll monitor, but I'll pass on. And majority of opportunities that I view that are discounts, I do in fact pass on. I think to your question of how asset managers can be better incentivized to do the right things and take proactive steps to remedy discounts and to not lock up their investors in vehicles that underperform. I mean, I think that's a really interesting question, and probably a bigger one as far as looking at the board construct, looking at potentially redefining what really is an independent director, obviously increasing the rate of turnover and the stacking, and also the transparency on the reporting. I mean, closed-end funds are underfollowed in a lot of ways because the reporting is, I don't want to say rubbish, but it's certainly far from ideal. I mean, there's only so much information you can get from a fact sheet, and the actual regulatory filings are oftentimes not really put together in the easiest ways to analyze. So it's a real issue, but it's also a real opportunity for funds like ours, where I'm willing to be a closed-end fund dork and spend my days reading 8Ks and CSS, the filings, and get on the phone.
Right. Jared, I think we got, if you want to run over to this guy here.
Do you use proprietary software to do all your trading?
Proprietary software.
So no public proprietary software is utilized, but models developed over 15 years that track, I guess a growing number of metrics that I think are drivers to forecast are utilized.
Now, so those two closed-end funds, it's very time-consuming for an individual. So the software does it for you.
So the concept of a software and that maybe would produce something like a Z-score, like the BlackRock funds do, I think makes sense. I think those types of softwares are very much of a initial first pass filter, and I think ultimately the returns are obtained through the sharpening of the pencil and the rolling up of the sleeves and really kicking the tires on the NAVs. And not just the NAVs and the discount, but also thinking about, what are the kind of catalysts that are down the road, and are they real and are they not? And I don't think that's something that you can really assign to a model. So I don't worry too much about I don't think of what I do as a trade. I think of it as a strategy, and I think that's what gives me comfort in its sustainability.
I was just wondering whether you would be put out of the job.
I would be put out of a job, but I'm not losing sleep over that.
Well, Jenaro, maybe that's part of why the the arbitrage opportunity remains there, because it can't be. There's not an algo out there that can just do what you're doing, right? It takes like a lot of grunt work, right? So there would have to be somebody setting up and doing what you're doing, I guess, to chase the same opportunity.
That's right. I mean, it's a time-consuming, passion job that I think one needs to be willing to dedicate the time and/or allocate the funds to.
Passion for 8Ks. Well, Jenaro, all right, before we wrap up, maybe you should just tell folks a little bit about your fund. So how it's structured like a hedge fund, limited partnership, or how does that work?
That's right. it's structured as a domestic hedge fund.
All right. Okay, well, I think we're going to move on to the next one here, but if anyone wants to follow up with Jenaro, hopefully he'll be around this afternoon and you can track him down. So,
Great.
Jenaro, thank you so much for that.
Thank you, John. Thank you all.